Good morning, ladies and gentlemen. My name is 𝗧𝗴𝗀, and I'm the senior strategist for �wealthpress. Today, we have our usual co-host and my co-troublemaker, 𝗧𝗴𝗀. How are you doing today, my friend? How's your day?
I'm good. How are you, Roger?
I'm doing well. And how's the weather in Miami? It's been kind of raining here last few days.
Not good. Just muggy, a little bit rainy.
Whatever. June. Typical June.
Yeah, it's this. Yeah. South Florida. This is Florida. This summer in Florida, but it's okay.
So what are you seeing in the markets ahead of the? We've got everybody's talking about the GDP, which is really weird because, and I hate when they do this, but they're putting the consumer sentiment report after the GDP. It would be kind of nice to know what the consumer sentiment is before the GDP, because GDP makes up 2/3 of consumer sentiment. But they always do it backwards. But they're expecting 6.4, 6.6%. What are you seeing? How are you looking at the market right now? What's your point of view?
The market's in one of these weird spots where everything is roses, right? Like if the economy is growing too strong, then we're rebounding like we should, and that's a good thing. And if the economy is weak, then we're going to get free money forever, and that's a good thing. And it's like, all of it feels a bit precarious to me. I know I've been saying that. I've been a bit Pollyannish about it, but it's like when you're sitting here, the problem is, like I'm an old school stock trader. I'd rather own stocks that are making money because they have awesome businesses in a really nice point in the cycle with great momentum at charts, technicals look good. Asset price is perfect, not too stretched. I like that kind of tape. And right now you have a lot of stretched prices. Like you have, just insane moves up and down. We've seen it in crypto, and it's not stable. It doesn't feel stable to me. It doesn't feel steady.
So you feel the market is a little vulnerable at this stage right now?
Well, it's like we're pricing in every possible good news on the planet at the same time. Like it has to be like the perfect situation. There has to be like awesome growth and no inflation, like forever. And then, the Fed is able to also grow the balance sheet from 8 trillion to 8 trillion, which is what it is right now, to whatever 12 trillion, or and the government needs to pass a massive, fiscal. I mean, I'm fiscally conservative, so I have to fight my own biases on these like massive, like gargantuan spending packages, et cetera.
What do you make of the bond market in terms of its reaction to the Fed's statements last week or so?
Yeah, you've nailed this bond move. Like the bonds did a really we went from 1% to like 1.7%, high 1.6s on the 10-year, and you said it would kind of be in the middle. It would come down a little bit, but it would just flat line. But it's not so much the yields that are the big story. The big story is more of the Treasury curve. And the Treasury curve has flattened. And the last time we saw the Treasury curve flatten like this, and for those people that don't know what flattening of the Treasury curve means, those people at home, it's when long-term interest rates, like the 30-year bond, come down a lot more than the short-term interest rate. So typically a normal yield curve is sloping upwards like that, with, if you borrow money for a few months, it's like you get 0.3%. And if you borrow money for 30 years, you have to pay 2%, 3%, something like that. But 30-year came down in yields. Short-term rates went up a little bit, actually. And this is actually, what's weird, this is bearish. This usually predicates bear markets when you see the yield curve flatten, and even worse, if it inverts, you usually see corrections in stocks.
Yeah, and I'm seeing that as well, and I'm glad you brought that up and explained it to the folks at home. And folks, if this sounds a little weird, rewind the tape, listen to what Jeff is saying. It's really important because we're seeing short-term rates and long-term rates kind of move in separate directions, which is not a really good indication for the medium term. It's also giving us an indication that the economy is a little bit confused right now, which based on what happened, it seems that way. It kind of has that feel to it right now.
Yeah, it's confused, but people, it's a defensive maneuver for institutions, because they know that over the course of 30 years, the likelihood that they're going to get paid back is pretty good. So they want to buy those bonds because, they feel safe in long yielding maturity, long dated maturity bonds. But they're nervous about what's going to happen tomorrow or the week after that,
Right.
or the month after that. So they have to keep yields a little bit higher. So there's nervousness in the short term, and then they're seeking safe harbor for long term, which is typically a bearish hallmark. But stocks don't care. Stocks are going.
Yeah, what's bothering me, what's concerning me, and I'm a big momentum guy, and we had about 2.5 months ago, we had 90% of stocks in the S&P trading above the 50-day moving average. Right now, we went as low as 30, and now we're at 40%. Yeah. But we're like a point or two away from all-time highs. So what it's telling us, I mean, the answer is simple. The answer is you have a couple of large cap stocks moving the market, and it's Amazon. A very narrow, but it creates so much vulnerability within the market, because you're literally holding onto the market by a shoestring. And with that said, you have a historic number of stocks trading above the 200-day moving average. So it's a real interesting environment we're in right now, And
I honestly think it's the liquidity thing. It's honest, like, why is Amazon so big? Because Amazon's a $2 trillion company with hundreds of billions of dollars of float that you can trade and you can buy and you can invest in. And they're looking to the hedge fund hotel is not only a hedge fund hotel, it's central bank hotel now. And they're looking at these stocks. They're looking at these stocks to park money, because the Fed is pumping out, $120 billion of new cash every month that needs to find a hotel, that needs to find a home. So they're going in these giant liquid asset classes. And that, for me, the bigger thing isn't raising interest rates. I don't think they have to raise interest rates. I don't think they should raise interest rates. I think interest rates are kind of good where they're at right now. They'll raise them when they need to raise them, and they can do that lickety split. But their stubbornness on like buying, mortgage bonds when we have the tightest housing market in American history is mind-boggling to me. Like, they're making the American dream literally the American nightmare. I mean, could you imagine, Roger? I mean, we're lucky we own our homes, right? Like, we've been in the game for a while. We own our places.
Yeah.
But could you imagine being like a 28, 29-year-old getting married, trying to start a family like we did?
I don't have to imagine. I don't have to
spot.
Remember, I came from California. I don't have to imagine. I lived it for 40 years. But yeah, when it comes to, but now, yes, but that was a joke. But yeah, totally. No, yeah. I totally. Now the rest of the country has to feel that way.
Well, I mean, it's not a lot of 29-year-olds that are sitting around with a couple $100 G's sitting in the bank.
No, and and I'm going to tell you, you just hit on something really important, and that was the most beautiful things. And I've talked about this several times, because I lived in California all of my life, and when I moved here, it was so refreshing to see young people. It was so refreshing to see people like my video guy. He has his own house. He's a kid. Kids have their own homes. They're not sharing it with 30 other people. They're working like they still are living the American life. And I'm afraid that based on what you're saying, that is becoming a distant memory. So unfortunately, I know more than most how it feels, because I grew up in California where that's the norm. I mean, people are rooming. Nobody has their own house. You don't have a middle anymore in California. It's poor and rich. So that 30 years ago, that ended. So I'm very familiar and I'm very happy. And one of the reasons why I like it here so much is because the energy is so good, because people can live like normal people, even if they're not multimillionaires. I love that. And
you are getting squeezed, though. That is getting squeezed at the margin. Yes. It's like, we've seen when you first moved here, that was definitely true. But I know your area pretty well, not as well as you, obviously, but I know Florida pretty well. And your area is one of like the undiscovered gems of the entire East Coast. That's the North Florida coast. And right now, it's been very discovered.
Yeah, prices doubled.
It's been there.
Prices have doubled in the last 3 years. Yeah. Prices have doubled, which is crazy. It's insane.
But that's why you have we love to talk about low-hanging fruit in stock trades. You think the home builders are going to make less money, or they're going to make more money? They're going to keep making money because they have the ability to adapt and to find these different places around the United States where you can still, as a builder, as a company, have a nice profit margin, and people can still make a living, and they can still get paid, and they can,
they'll be okay. I think they'll be okay till rates hit a certain level, because these large scale builders, they continue. Their capacity is, Well, now they've got the whole inflationary pressure too. But aside from that, when rates stay at a certain level, they just have the green light. And when it goes above a certain level, they lower it. And it's just very mechanical at this point.
Yeah.
And I'm talking about the big, the big ones.
Right.
But yeah, it's we are in a pickle right now. And now I'm sure you have heard, and I really want to hear your opinion because I haven't talked about this yet. I'm going to start talking with my guys about it. But I think the time is now ripe for it. What do you think about this new Delta variant we're hearing about? I've been hearing it all over the news last 2 days. I'm hearing that we may have another major resurgence. God forbid. I hope it never happens. But what's your take? What's your view on this?
So it's a kind of like my original thesis. The impact from a medical, and I'm not a doctor, so let me preface this by saying I don't even play one on TV. I'm not a doctor and I do not play one on TV. But the vaccines work against the variants, no matter what people tell you. They work. The variant, if you have the vaccine, there's like an ultra minuscule percentage probability that you would acquire the Delta variant with the Pfizer or the Moderna 2-shot vaccine.
Jeff, is that what they're saying? I just don't know, so I'm getting clarity.
That is what they're saying.
Okay,
the problem is, and the reason that they're, the media loves like spinning up the doom and gloom, scary shit report. The problem is that it's more contagious and slightly more lethal for the younger group of people, cohorts that have not been getting vaccinated at the same degree of widespreadness as people above, our age that have all like gotten it. So the problem is that the Delta is spreading amongst like teenagers to 30-year-olds, and it's worse for them than the normal one. That's the problem. So we'll see. But, again, the vaccine works. So you just need to get people vaccinated. But the knockoff effect, the knock-on effect of that is that people are still in their minds, not like thrilled about the fact that there are vaccines that people distrust the news, right? So we know that everybody distrusts what the TV is telling them, what the media is telling them, including myself, including yourself. We just all take it all with a grain of salt, right? So people are out there saying, I don't know. They didn't know where it came from. They thought it came from bat soup 12 months ago. Now they don't think it came from bat soup. Now they're saying the Delta is different. It's more deadly. So nobody really knows to make heads or tails. So as a natural reflex, people are just like, you know what? I'm still not going to I'm still not crazy about commuting to the office. I wanted to ask you about that. A lot of people, CEOs of big Wall Street banks are like, get your ass back into the office. These old crotchety guys, like, I'm paying you New York City, Wall Street finance wages. You're getting better money than anybody in this country. I expect you to be at your desk at 7:00 with the research report. I mean, I've worked for these guys. These guys. You've worked with these guys. And it's just like, they don't get off that. But I have a different view. I have a view that people are like, you know what? I'll find a different job that allows me to sit in my house, go to my kid's baseball game, much safer. I'm scared of the Delta variant. And I'm bearish because of that long-term still on commercial real estate, because I think psychologically, we have like a mass societal PTSD that's not going to just get brushed underneath. People like me, I'll go to a sporting event and stuff. I'm fully vaccinated. I have a little bit different mentality about it, but I still can have the understanding that not everyone feels the same way.
Yeah. So you're the major crux of the issue is you believe commercial real estate is still going to be struggling for quite some time.
So I read a really cool study. You'll love this because you're an analytics geek like I am. They, in like New York City, to get in an elevator or to get into any office building, you have to have like a fob card that you swipe on. Of course. Because massive city, you can't just let people just walk in and take.
We have it in our office, so
Right. Well, there's like a major fob. There's like one major fob player in the whole city, and they know how many people are fobbing in to work in New York City. And I want you to guess how many people are fobbing into their offices, walking physically into their office in New York City as of like 2 weeks ago, compared to pre-COVID.
I would say comparatively speaking, on a percentage basis, about 10%.
A little higher. It was 25%.
Wow.
But still a quarter. And there's 70 north of 70% vaccination level in New York City. Like people are vaccinated.
Oh, New York. Okay, I didn't hear the New York part. I thought it's New York. Yeah, New York
City,
bigger city.
New York City. So the point is, these guys are having a hard time even with the vaccine. And I've heard like James Gorman of Morgan Stanley. I've heard Jamie Dimon of JP Morgan, who I have tremendous amount of respect for, say, we need you guys back at your desks. But it's like they're not doing like an amazing job of getting that to actually be the case. What you're hearing on TV, what people are saying in the news, what these, the official stance is, you have to be there. But the reality is a quarter of the people are there.
Interesting.
So like when is what's going to be the major catalyst to get everybody to go back in? They're saying it's the summer, maybe after Labor Day, people want to go to the beach. I don't know. I mean, I've been around this planet for a long time. You get like a week vacation in the summer. You don't get 3 months to hang out at the beach.
That may make I know you're a links trader. That may make a very good trade. You could go long residential.
I have that trade. I've been giving you. I've been foreshadowing. This was a new trade. Tell me.
I want to hear about
the retail home builder. So XHB, I'm bullish on because people are still like into housing, and they're going to be into housing, and there's not enough. The demand is off the charts, even with it being incredibly unaffordable. They still want to have it because they're just at the point now where they can still afford it barely. But they're scared to get to the point where it's like totally unattainable. So they want to lock it in. And I think it stays like that for a bit. And then I'm short Simon Property Group, which is a major retail or major commercial malls and, office buildings and stuff.
Simon Property Group was my most bearish stock for 2020, by the way.
And it's had a nice run. So I was waiting for this nice run to leg into it. So it was a good spot. It's a good spot, I think.
Jeff, this reminds me of a trade that I put on about, 6-9 months ago. Time gets away from me. You'll remember. We talked about it here, actually. It was the 𝗧𝗴𝗀𝗀 Financial versus American Express.
Yeah.
Consumer credit. Consumer credit, how people in consumer credit is going to pick up before business credit, which goes in line with what you're saying right now, completely.
So enough about me. Let's talk about you. What are you playing? What are the big things you're playing? I mean, what's Roger doing?
Well, here's my point of view. I am right now. There's a few things. I called the bond upside, which took tech higher. So we got on that ride.
Yields lower, bonds higher.
Right, and which took the blue chips lower, and which we expected to happen. So we kind of got out of the blue chips. We got into tech, but now here's the interesting part, and here's the problem with my theory. Everything is working out as I expected, except one little wrinkle. Tech is not pulling back because interest rates are going higher, but tech is not pulling back.
Nasdaq was at all-time highs.
Yeah. So I'm thinking the expected earnings now at this point for the end of the year tech have gotten above the expected yield on the 10-year based on the expectations that the Feds have given us. That's the only thing that I can explain. But in terms of what I'm looking at, what I believe is hot, I'm still very bullish on energy, traditional energy.
Yeah.
I'm right along with you on that.
100%.
I think we are going to see a bounce in the blue chips. I think we are, but I'm very nervous about the vulnerability in the S&P right now. So the way I've been playing this week has been very, very cautious and telling people to pretty much lower their exposure substantially going into the GDP. I think I want to see a little more performance out of the stocks. And actually, quite honestly, the only S&P sector that I'm really kind of neutral on right now is the real estate sector and the utilities sector.
I got it.
And utilities kind of makes sense because the stock market is near all-time highs, and that's a defensive sector. So it'd be kind of weird if it wasn't. But real estate, I'm starting at the 𝗧𝗴𝗀 ticker symbol. I'm starting to it's not bucking the trend to the upside as well as I expected. And we've been seeing so much overestimations on the real estate. So I think that has kind of priced in everything it can for the time being.
Good point.
So I'm cautiously optimistic on the basic materials. I think they will come back, although I'm nervous about how big the decline has gotten. But I think we will see a bounce from them over the next few weeks.
Isn't it amazing that we had 20% down in copper, 30% down in lumber?
Overdone.
Oil is at year high still. not even a 5% pullback.
Right.
Isn't that amazing?
Yeah.
That tells me that oil is ready to just like, you're going to be seeing gasoline prices this summer that they're, even like the most dovish, benign people on television that, the guys that always want to pump this shit and say it's awesome. And 𝗓𝗃𝗀𝗀 is one of these guys, are not going to be able to hide around the fact that gas prices are going to be very painful, in my opinion, on the American consumer.
I did a story on energy markets 2 days ago, and it's what's fueling high oil prices. And here are the factors that I put in. I mean, I'll just kind of give it to you since we're on it. We are now at a 2.5-year high. All right. Which means the companies that are, most people know now that the higher oil prices get, the easier it is for the companies to free up cash flow, to repay debt, drill more wells.
Yeah.
OPEC is also agreed in the beginning of June to continue its current pace of gradual returns to the output of the market.
Yeah.
We've seen oil prices more than 5 million barrel decline in inventory levels earlier this month. And again, it looks like OPEC is playing ball. The two stocks that I picked, by the way, were Schlumberger and EOG. Just FYI, I figured I'd tell you that as well. But I do believe we're going to see. I think we're a little overdone on the basic materials. I think we're going to see more upside.
I agree. Reflation trade's going to come back. But
I think we are going to see a fizzle on the tech stocks and on the large cap.
It's probably a good time to rotate out of tech back into commodity related stocks.
Yes.
I think you could see a shot. I think everyone has kind of like been lulled to sleep with this bond move, but I think you could see the yield curve go inverted or not inverted, but flatten a lot more. And I think that would cause that could cause a panic sell-off in all bonds.
I would not be surprised. Although I'm not seeing a major downside. I'm not seeing the reversion to the main, and I've mentioned this to you several times as well. I'm not seeing bond markets really dive till I'm thinking end of towards August, June. I mean,
I think there's a cascade of events. I think you're going to have the way it plays out, in my opinion, is you have really robust numbers continuing in GDP and things like that. You have CPI running way too hot, like close to 4%. You have real rates very negative, incredibly negative because of that. And then you have this gas move that's going to be this. It's literally going to, in my opinion, this is the story of the summer of 2021. It's going to be like 1979 all over again. It's going to be like the dominant head. Write this down at home, kids. Remember, Jay-Z told you this back in June. By the 4th of July, people are going to be just pulling their hair out. They're going to be looking like me saying, what the F? How am I going to drive across the country to see grandma and grandpa? Everybody's got the vaccine. I can't afford it. It's going to be a big problem. And then the Congress is going to say, well, we'll just give everybody some sort of like stimulus to make up for it. But, doesn't work because it's going to stick, because it's not going to be transitory. It's not going to just come back down.
Right. No.
There's sit there.
Yeah. And just to remind everybody at home, commodity trends tend to last a long time. I keep telling that to people. It's not like stocks. Like, notice gold didn't go all the way down to like the $280 level.
What do you think of gold? What do you think of gold?
I think, well, it's interesting you mentioned gold, because every time I think about gold, I'm now thinking about crypto. Ever since all the third world countries decided to adopt crypto, it, I'm thinking gold now. I think the miners are still. I think a select few miners are still going to see some upside.
Right.
But generally speaking, I think I'm neutral right now on the gold market.
Yeah.
Not bearish, just neutral.
It's a no play.
And typically, precious metals are they're not a big summertime play. Just FYI as well.
That's good to know.
Before, on a cyclical basis, metals are just not that. I'm talking about silver and gold. Copper is a whole different. Yeah.
Platinum.
Crypto. I want to talk to you about crypto. Yesterday we broke major support level. Now things. I'm not you and I are both in the same opinion. Crypto.
Yeah, you have to pay attention, but we're not.
You got to pay attention, but we give it about as much weight as a speculative penny stock. 5% of your portfolio. It doesn't make up a meat of anything we do, and it shouldn't. It's too volatile.
No.
Any updates? What are you thinking? What are you seeing? Anything at all? You think we've had the best days are behind us? What do you think?
No, I don't. Because I think it's part of the reflation trade. I did a video of this last week. I think it was $1, like a big move that happened post Fed that not a lot of people talk about because they don't really, think about macro too much, is that the dollar, which has been going down like in a straight line for 2021, had a huge couple of standard deviation event in a day, made like a 2% move across like emerging market currencies. It was like 3%, 4%, big move last week in the dollar. And crypto, like all, assets or currencies, whatever you want to call it, are priced in dollars. So if the dollar goes strong, those things go weak. Now I'm paying attention to the dollar because if the dollar goes really strong, which I don't expect it to, I expect it to like plod along, maybe have a little bit of a 50% mean reversion from highs to lows. It made a high, so that when the dollar is really strong, kids at home that don't know this, last March, the DXY index was at about 104. And that's when stocks went down 30%. So super strong dollar. It's very, very painful for growth stocks, for the growth world too, for that matter, for tech, for everything, components, for everything, logistically, asset prices, everything. So you have to watch the dollar to see if it gets too hot or not. But the one thing I'm super impressed with the whole crypto thing is that they could have such a steep crash type of sell-off and have no like systematic breakdowns.
Yeah.
You know what I'm saying? Like,
yeah.
That happens in the stock market. You have X, Y, and Z investment bank just went under, and then the ripple effects are so magnificent and so profound that people are starting to panic to go to the bank and pull money for the weekend.
Right.
And that didn't happen in crypto, which for me is actually like long-term a big positive.
Well, if it starts gaining strength at these levels and starts breaking highs, I think you're going to get a lot. I think every time crypto makes new highs, it's going to sucker in so many new people into its trend. And
the problem is it's so intense and it's so extreme, and it requires like such a high level of, like, if you're trading it, it requires like peak trading ability, because people always do the wrong thing. People always buy when it feels good, when the sun's out, when it's at like 50,000, 60,000, and then they panic and they puke it at 27,000. But I bought a little bit of crypto. I bought a little bit of Ethereum yesterday around 1,700, and it was like 4,000 a month and a half ago. And I bought before at like 2,500, then it went to 4,000. I took half off, and then it came back down because I'm an experienced trader. So that's what I'm doing. I'm using the moves to trade around it a little bit. But people do it the opposite way. It's like they go buy GameStop when it goes to 350 because their friend on TV, their friend on Twitter told them to do it, or on TikTok, their daughter showed them a TikTok and they did it, and then they puke it. The dangerous ones that are really breaking down are some of the altcoins like Dogecoin, which Dogecoin was like 70 cents back down to 20 something cents.
Yeah.
That's where you could really you could literally have like a zero on your hands with one of those things.
Right.
But I don't think that's going to be the case with a Bitcoin or Ethereum.
No, and I'm also a fan of Ethereum. I like it a lot more than we've talked about that.
True.
A few more things just to really quickly before I let you go. Sure. One other thing that I'm seeing, I should have said this earlier when you asked me what I'm seeing, but one thing that I am seeing is a divergence between electric vehicles and solar batteries. And the car makers and the actual, the basic material, the lithium players, the solar, I'm starting to see, before everybody was putting them all in the same basket. It was like solar EV, solar EV space. I'm starting to see a divergence between them. I'm starting to see some bullish trends in the EV stocks, whereas the solar battery stocks, especially with the dump in basic materials, are still sagging quite a bit. So non-traditional solar stocks compared to regular energy, I'm bearish on, but I'm becoming bullish again on the EV stocks. And if you think about it, as the industry matures, they are two separate. I mean, you can't really, computers, it's like Dell and Applied Material. They are connected, but they're not. So with time, as the industry matures, and it's maturing very fast, you are going to see a split between those two industries. And it's only fair, So just something to for those of you at home listening, start looking at EV and solar stocks as two separate entities.
That's interesting. I like that. You're very cognizant of the life of the business cycle, which is an important. It's like, there's so many aspects to this game. Like the more layers of the onion you peel. So that makes total sense that they would diverge.
They're starting to. They're starting to. Something to keep in mind. Listen, Jeff, I can go on with you forever and ever and ever, but this was an amazing session. Folks at home, please, please, please feel free to reach out to us. We are doing this so that you guys can get into this conversation. We want to make you part of this conversation. Yeah. We'd love to answer questions. If you guys have a lot of questions, we'll even have a video where we answer these questions. We could do that too. Please reach out. It's Jeff@𝗧𝗴𝗀𝗀.com. Jeff@𝗧𝗴𝗀𝗀.com. And his link trades are hot. I mean, these things are hot. I love these trades. You got to check these out. Really good. And it'll teach you the dynamics of how the market works, because Jeff picks related sectors, but have different qualities to them. So it's a very good way to earn while you earn. Learn while you earn. I love that. So, and my email is support@marketgeeks.com. So that's Jeff@joyofthetrade.com, support@marketgeeks.com. It'll bypass a few layers and get to me fast. Jeff, thank you, thank you, thank you. I love these sessions. I cannot wait till next week. Folks at home, be careful out there. We've got the GDP tomorrow. We want to make sure your positions are a little lowered because volatility is going to be higher. Jeff, thank you once again, and I will talk to you later this week.
Thank you, Roger.
Bye. Take care. You too. Bye.